What if you could wake up whenever you wanted and have unlimited time to spend with your family, travel, or work on your hobbies? Most of us were taught that the only way to make an income is to work for money, but there is actually another way you can either work for money or you can make money work for you. And I am going to share with you 5 ways to do that and create passive income. It does not take a lot of money and does not take any special skills. Anyone could do this. So, Let's jump into it first. Let's talk about dividend stocks because this is where a lot of people get their start. First of all, what is a stock? It is not some sort of conceptual weird thing that squiggles around. On a price chart, it is actually a piece of an actual company. So when you buy a stock, you are buying ownership in a real-life operating business. That business has factories, stores, customers, and sales. And by owning a piece of it, you are entitled to a share of those profits. So at its core, when you buy a stock, you are buying a piece of a company. And you should never forget that because it makes the whole thing tangible. Now, among all the companies that you can invest in there are businesses that make so much profit that they have plenty left over after paying all their expenses and investing back into the company for future growth. They distribute that extra cash to you, the owner. This is what is called a dividend, and companies will normally pay these out on a quarterly basis, which means 4 times a year, every 3 months, you are going to get a cash deposit in your account just for doing nothing other than owning that stock. Stocks that pay good dividends are usually companies that are stable and have a long history of profitability we are talking about. Established giants like Johnson and Johnson or Procter & Gamble rather than some brand new startup in terms of how to pick good dividend stocks. Your ability to receive payments depends on whether that company stays profitable. You want to look for companies that have been around a long time and have a consistent history of never cutting their dividend. You also want to look for the dividend yield, which is a percentage that shows how much money you get for every dollar you invest. The higher the percentage, the more bang for your buck you are getting. But you have to be careful with yields that look too high. Usually if a yield looks too good to be true, it probably is, and it might mean the company is having serious financial issues. It is safer to look for yields that are in line with similar companies. In that same industry right now, you can get started with as little as $20 because platforms allow you to buy fractional shares. Even with $1,000, you can spread that across a few great companies and start seeing those deposits. Hit your account. Number 2 is dividend index funds, and honestly, I think this is an even better way to get started than individual stocks. This gives you the benefit of something called diversification, which is just a fancy way of saying you are not putting all your eggs in one basket. Diversification is nice because you do not have to worry so much about one specific company or one specific CEO making a mistake. Instead of buying one flower, you are buying the entire bouquet. And it all comes in one nice, easy purchase when you are picking dividend funds. Or ETFs, the most important thing to look for is the expense ratio. These are management fees that can range from 0.03% to over 1%. And they really add up over time. You always want to look for a fund that has a low expense ratio so it does not skim off your long-term gains. For example, the Vanguard High Dividend Yield ETF, which has the ticker symbol VIM, is a huge favorite in the community as of right now in May 2026. Its yield is around 2.5% and it holds a massive basket of high quality companies. Another popular one is the Schwab US Dividend Equity ETF, or SHD, which currently yields around 3.2%. Now you might see some funds offering crazy yields like 10 or 12%, like the JP Morgan Nasdaq Equity Premium Income ETF. That fund uses complex options and derivatives to generate extra income, which can be great, but it comes with way more risk. If the market moves in an unexpected way, you could actually lose a portion of your principal investment there. So if a yield looks really high, just know that there is no such thing as a free lunch in the world of finance. A good rule of thumb is to compare the yield to the current interest rate set by the government, which is the Fed funds rate right now. The Fed fund rate is sitting around 3.6%. So if an investment is paying way more than that, you need to dig deeper. Now for the third passive income investment you can make with $1,000, and that is bonds. Bonds are very different from stocks because when you buy a bond, you are actually lending money to a company, or a government lending is generally a more conservative way to put your money to work. Because you have a all agreement to be paid back, you are guaranteed a return of your capital plus fixed interest payments along the way. So it is very safe and predictable compared to stocks where the price can jump all over the place. Bonds are like the steady ballast for your portfolio. One really standard way to see how safe a bond is to look at its rating from companies like Moody's or Fitch. Anything in the AAA or AA range is considered a high-quality investment, while lower ratings are much riskier. Just like with stocks, I prefer to use bond ETFs to get instant diversification across thousands of different loans. A great example is the Vanguard Total Bond Market ETF with the ticker symbol BND, which currently yields around 3.9%. This fund gives you exposure to both corporate bonds and government bonds all in one single ticker symbol. If you want even more safety, you can look at government bonds, which are backed by the full faith of the United States. Or if you live in a high-tax state like California, you might look into municipal bonds for some unique tax advantages. advantages moving along to the next passive income investment. And this is one of my favorites, which is REITs, or real estate investment trusts. A lot of people think you need tens of thousands of dollars for a down payment to invest in real estate, but that is not true. REITs are essentially companies that own and manage a huge portfolio of properties like apartment buildings or shopping malls. They are legally required to pay out 90% of their taxable income to shareholders in the form of dividends. So when the tenants pay their rent, the REIT passes that money directly to you without you ever having to fix a toilet or manage a tenant. I love REITs because they give you professional management and diversification across thousands of properties. You can find REITs that focus on specific sectors like healthcare facilities, data centers, or even self-storage units, for example, Realty Income, which has the ticker symbol O, is known as the monthly dividend company because they pay you every month. As of right now, their dividend yield is sitting around 5%, which is a really solid return for real estate exposure. Remember that with REITs and stocks, you are not just getting the dividend, you are also getting the potential for the price to go up. The fifth and easiest way to generate passive income right now is a high-yield savings account. This is not really a traditional investment, but it is a perfect vehicle for your emergency fund or short-term savings because interest rates are still relatively high in 2026. You can find online banks paying around 4% API. These accounts are protected by FDIC insurance, which means your money is safe up to $250,000. It is completely liquid, so you can take your money out whenever you want, and your balance will never go down in the long-term stocks, and REITs will likely grow your wealth way more. But you should always keep some cash here. If you have an emergency fund sitting in a regular bank making 0.01%, you are literally losing money to inflation. Switching to a high-yield account is the easiest win you can have to start generating passive income today. So let us summarize your toolkit for building wealth. With $1,000, you have dividend stocks for ownership in great businesses, and you have dividend ETFs for instant diversification. You have bonds for safety and steady interest, and you have REITs for easy real estate exposure. And finally, you have high-yield savings accounts for your cash and your emergency fund. All of these are really easy to get started with, and you can begin with even less than $1,000 if you need to. Just because investing a small amount won't let you quit your job tomorrow doesn't mean it is not worth doing. I really want to emphasize the power of starting small and staying consistent over the long run. If you start with zero and get to $50 of passive income a month, that is a huge psychological win. That $50 can pay for a dinner out or a subscription that you didn't have to work. For everyone starts at zero, and my first dividend payment was only $2 from some McDonald's stock I bought years ago. Now I receive thousands of dollars every month, but I had to go through the same process of starting small. Don't underestimate where you can get to if you just start today and keep adding to your portfolio biweekly. Thank you so much for watching, and I hope you found this breakdown helpful for your journey. I will see you next week for another video, and in the meantime, keep focused on your goals. Thanks for being part of this community, and I will see you in the next one. Bye.